Let's get a little bit of a deeper dive into these numbers. Our Brian Cheung is joining us now. Brian, we have been digging into some of these numbers, and the overall number is not great, but even some of the underlying numbers look even worse.
Yeah, absolutely. Especially when you look at sector by sector, leisure and hospitality taking a massive hit with over 600,000, or rather about 500,000 jobs that were lost between November and December. But I want to also call your attention to some revisions that were made to previous months in addition to the December numbers that we got. In October, there was a revision upwards of 44,000, then a pretty large upward revision for the month of November that was 91,000. So if you total those two things together, actually, those 2 months had about 135,000 additional jobs more than they were previously reported. Now, if you take that in tandem with the loss of 140,000 jobs in the month of December, this does kind of negate those effects out. Now, of course, that doesn't necessarily mean that things are better. The trend that we saw between the November and the December reports does clearly show a sharp tick downwards, which could be extended through January, February, and March, as we've heard many economists say through this dark winter with a lot of businesses forced to shut down. But it is important to note that there were revisions to October and November. And then something else that was pointed out earlier at the top of the show was that average hourly earnings really came in quite hot, 5.1% on a year over year basis when we look at wage growth. This is something that the Federal Reserve has often looked at as a sign of inflationary pressure. But changes since the Federal Reserve's kind of changed its thinking in the August Jackson Hole meeting shows that they're really not necessarily scared of seeing inflationary pressures from wage growth itself. They would like to see more evidence of that kind of bleeding into actual core personal consumption expenditures. So whereas a previous Fed, let's say even a year or two ago, may have reacted to this and said, hey, maybe this would tilt up our expectations for a rate hike at some point, I wouldn't expect that to change the Fed's thinking, because that idea of needing to change the reaction function to the non-accelerating inflation rate of unemployment is not necessarily as strong as it was in the past. And then one last thing I want to call attention to is the disparity among different racial groups in that December jobs report. Yes, it's true that 6.7% unemployment rate on the headline was unchanged. Actually, if you look at different races and ethnicity groups, Hispanics actually saw a higher jobless rate in the month of December. It went up from 8.4% to 9.3%, a pretty noticeable change, likely owing to the types of industries that were impacted as a lot of these shutdowns began again. So again, not necessarily a good report. It'll be interesting to see whether or not those trends continue in the coming months.
Brian, I want to also ask you about participation, because that is about 2 percentage points below where it was same time last year, 61.5% December, down from 63.3%. And that's obviously been in secular decline now for a couple of decades. You mentioned, average hourly earnings as a measure the Fed was watching. Also, participation, particularly prime age participation, was something that the Fed wanted to see kind of tick up before we started thinking about changing our stance on policy. I'm curious how this Fed, in your view, might look at that kind of a measure, because obviously you've got aging demographics in the U.S. that's going to weigh on that. But ultimately, when you have 57.4% employment to population ratio, it's not great. It's certainly not the kind of thing that you'd like to start cooling off the economy into that kind of number. I'm curious, how you think the Fed might view those sorts of secondary measures of the health of the labor market.
Yeah, absolutely. And we do have to make note of the fact that, yes, we're in the middle of that pandemic. But as you point out, Miles, a lot of that trend when it comes to specifically prime age employment to population ratio, really it does kind of discuss a lot of these secular trends that have been in place that have really nothing to do with the pandemic. So when you think about things like an aging population, just the different types of industries and the way that technology has kind of changed the need for skilled work in this economy, a lot of those kind of secular trends have caused that kind of employment to population ratio and the labor force participation rate to kind of be stagnant or even tilt down in some cases. Now, whether or not the pandemic is going to exacerbate that, I think is the real question with regards to how Fed policymakers approach this question. If the idea here is that a lot of these job losses, which it does appear to be the case, will be permanent, then that could signal even further downward pressure on the ability of the Federal Reserve to pull in more people into the labor force. It was definitely the case that after the last crisis, the Federal Reserve was optimistic that they could pull in people that had previously given up on looking for work back into the economy. We saw that there was a hot labor market. The unemployment rate at a headline level was 3.5% before the pandemic. The Federal Reserve is kind of looking at that trend mark to say, is it possible to get back down to 3.5%? And that gets to the heart of your question, whether or not there's going to be permanent scarring in the labor market. And when you look at a report like this in January, what we saw is that with the contraction of that headline non-farm payroll employment, that means that people have gotten jobs back during this pandemic, but then lost them again. What is that going to do to them long term? And I think that's really going to tell us where these longer term trends go when you look at LFPA or the participation rate.
Brian Cheung, thank you very much. Appreciate it.